all kinds of changes in the tax laws and estate planning laws coming into effect. Some in effect, some coming into effect. Who better to talk to than one of the leading CPAs in Southern California, and by coincidence, longtime friend of mine and fellow Trojan and fellow debate team member at USC in the 1980s, David Ellis of Ellis Ellis CPAs. David, thank you for coming back to our program.
Thanks for having me, Bill. It's an honor. As you know, we had a major tax act passed on July 4, 2025, and the implications for estate planning are very significant. In a way, it's a sea change. And I thought maybe we can talk about some of the major items. Of course, won't get too deep in the weeds. We'll just kind of highlight them so people have some awareness. And maybe they can go and talk to their estate planning attorney or CPA and explore some of these new possibilities.
Well, let's start with that aspect of it, which is, I think you say it right on. The goal today is not to get into the weeds and details, provide continuing ed for either an attorney or CPA, but it's more to highlight the areas that somebody should be aware of, and then talk to their CPA, hopefully you, and or their tax planning attorney or estate planning attorney about these questions and get the right answers for them. So let's start from the beginning. What are one or two of the major changes that you think are going to have the most effect as a result of the tax laws? Oftentimes there's laws passed, people expect the world to change, and then nothing really happens. What are one or two that you think are going to have an effect on people's planning or should have an effect on their planning?
Okay, so without a doubt, the biggest change we've had, and it's a change for the better, is the $15 million basic exclusion amount from the state and gift tax has now been made permanent. Okay, so that's $15 million per person. So a married couple now has combined $30 million that they can shelter from estate tax and gift tax automatically. So that takes the vast majority of taxable or estates out of the estate and gift tax realm, and really just, it in large part leaves us with people with these estates over $30 million where we have to worry about the estate and gift tax. However, I will say this, it doesn't mean that somebody who has less than $30 million has to ignore the issue. For example, let's just say a couple had an estate worth $10 million and the first spouse died. And well, of course, his, half of that would be $5 million, and no estate tax return would be required. If you did nothing, okay, the $15 million exemption would die with the spouse who was deceased. And when you say, well, no big deal, we've only got a $10 million combined estate, no problem. Well, what's going to happen if the surviving spouse lives another 30 years and her $10 million estate is now a $40 million estate, which, with inflation and the right investments, is it all possible, or is possible? So now she's going to have a pickle. When she passes away, she will have taxable estate tax. So there, at a minimum, what we're advising people, if there's any possibility that the estate of the surviving spouse will grow to over $15 million, you need to file that 706 estate tax return, and you're doing it for purposes of portability, okay? And what portability means is that when you file the estate tax return for the first spouse to pass away, let's just use the example, say his share of the estate was $5 million. We file the estate tax return, we take $5 million of the $15 million exclusion that he's entitled to, and now we have $10 million remaining, right? So that $10 million ports over to the surviving spouse. So now when the surviving spouse dies, she doesn't have a $15 million exemption. She's got a $25 million exemption. And that is extremely significant, because at a 40% estate tax rate, that would save her, her heirs, her estate, approximately $4 million in estate tax. So I think the takeaway is, if there's any possibility that that second spouse is going to go over $15 million, and that's not that hard to do in Southern California. If you have a couple of rental properties, and you've got a house in Brentwood, and maybe some investments, you can easily go over $15 million. So don't get lulled into inaction just because this exemption is now $30 million per married couple. It still requires action.
Well, and getting the right action is less expensive. $400 is less expensive than your fees, I believe, correct?
Exactly. So what does it cost to file an average 706 return when there's no tax liability? It's going to vary, depending upon the complexity of the state and all the rest of it. But you're probably looking at a preparation fee of, somewhere from $5,000 to $15,000. So that's real cheap insurance to get that portability. Now, one thing I do need to mention, if you have a taxable estate and you're eating into, the deceased spouse share of the estate is over $15 million. In order to get the portability, you have to file a timely estate tax return. Okay, so it needs to be the estate tax return is due 9 months after the date of death, and then you can extend it for another 6 months. So you basically have 15 months to deal with it. If you don't do it within 15 months, and there is part of the taxable estate, then you lose your option for any portability. Now, if you don't have a taxable estate, you have up to 5 years from the date of death by making a special election to get that portability in there. So the reason I'm saying this, if somebody's listening to this and they said, oh, my spouse died 3 years ago, we didn't file the timely estate tax return, you do have up to 5 years. If you miss the 5-year deadline, you're still not completely out of luck. What you have to do is you have to request a private letter ruling from the IRS, and basically, something like, I wasn't aware of it. I got bad advice. The dog ate my homework. I was, in outer space, a prisoner of the Martians, or whatever it is. You can still possibly get it, but it's much better to do it within the 5 years. And if part of the estate is taxable, you've got 15 months. That's it. There's no coming back from that. So be mindful of that when your spouse passes.
I was surprised when I started working with larger estates at how long the IRS takes to review a tax return for a large estate. Meaning we have requirements to do things in a certain time period in probate court and trust and such. What's your experience? What's the average time period? You file a tax return for a trust or estate that might be $5-6 million. When does the IRS actually review it, and are you past that obviously subject to audit or review if something comes up, but at what point have they accepted the filing and the taxes and you can move forward?
Yeah, okay, so the statute of limitations on a 706 return, and most tax returns is, assuming no fraud or anything like that, is 3 years. Okay, so they've got 3 years to audit the 706 return, and this is a constant battle back and forth because people want to close the estate, and I understand that. You can move there's a form you can file for a quick closure of the estate, and basically tell the IRS, we want to close this up. Let us know if you want to audit this. If you don't want to audit this, they have to reply within a certain period of time, and then you get what's called an estate tax clearance letter. So that the issue you run into, is it better to ask for a quick closure of the estate and draw attention to yourself, or is it better to just let the 3-year statute of limitations expire? And that really depends upon what exposure you think the estate may have, how clean it is, things like that. And always, when you close an estate, you've probably seen this before, it's not a bad idea to keep a contingency fee, especially if you're going to close it up and distribute before the 3-year statute of limitations. Because what's going to happen if in year 2.5 you get the letter from IRS and they audit the estate and they make an assessment? Well, if there's no contingency fee in the estate, guess who has to pay for it? The executor of the estate, right? The IRS will come after you first if you've bankrupted the estate, in other words, distributed all the money. And then if they can't get it from you, they'll try to get it from the beneficiaries, but good luck with that. So this is another thing I advise all my clients. Think very long and hard before you agree to become a trustee for an estate. A lot of responsibility goes along with it. It is a lot of paperwork and it's a lot of liability. But the bottom line is, I advise keeping a substantial contingency fund available, certainly until the IRS statute of limitations closes, which is 3 years. The state of California does not have an estate tax return, so you don't have to worry about them. But the other thing you're going to have, okay, so there's a 706 estate tax return, which is basically part of the transfer tax. It's the gift and estate tax regime, which is different than income tax. A lot of people don't realize this. The 706 tax is your tax on transferring wealth. When you give money or property to people or when you pass away. As we just said, there's a $15 million exemption per person. So for most people, it's not an issue. But you also have, in most cases, you have some income tax on these estates. That's on Form 1041 and Form 541. Because, say, for example, the estate has assets and rental property. Rental income is still coming into the estate. Interest and dividend income is still coming into the estate. That tax has to be paid somewhere. The estate will have to file an income tax return. And then you, as the fiduciary, will have to make the decision whether or not you want to pay the tax at the estate level or whether you want to pass it to the beneficiaries. In most cases, it's best to pass it to the beneficiaries because beneficiaries are taxed at a much lower rate than estates and trusts are. Just by way of example, again, talking about income tax here, not transfer taxes. In round numbers, an estate on Form 1041 income tax will hit the top bracket of 37% after about the first $15,000, which is not a lot of money. Okay, for a married filing joint return, you hit the top bracket of 37% at about $600,000. So now you can see why a smart fiduciary and many professionals advise you want to pass out that income to the beneficiaries and have it taxed at their lower rate. Now, if everybody's rich and everybody's making $1 million, it really doesn't matter, right? But in most cases, most people make less than $600,000 on a joint return, so you need to do some bracket planning and some income tax planning. But to get back to the point, the IRS statute of limitations on these Form 1041s, these income tax returns, fiduciary tax returns for the estate, statute of limitations on that is 3 years unless there's what they call civil fraud. Well, civil fraud means you've understated the income by 25% or more. In that case, which is a pretty, it's a pretty big mistake, right? Okay, in that case, the statute of limitations stays open for 7 years. And in the case of the state of California, you have to deal with an 8-year statute. So for where there's income tax liability, which will be the case with most large estates, especially if there's rental property, the rentals are still going to keep coming in. You're looking at, probably 8 years and maybe add 9 for good measure, to have some type of contingency fund just in case your estate's audited and you have to pay the accountants and the IRS comes up with another determination and things like that. So, that's in the, somebody who wants to be super, super conservative. I don't know if you would always want to wait 7 years, but certainly 3 years on the federal and 4 years on the state. And then I add an extra one, just for good measure. So you're talking, keeping your records and your contingency fund, for about 5 years.
Oof. I agree with you 100% on not wanting to be the trustee. I had a family member pass, and it turned out I'm the oldest of my siblings. My sister called almost apologetically, I'm sorry, I assumed you were the administrator because you know this stuff, but she named me for the reason. I'm like, great. Glad to hear it. I'm here to help you, honey. But
Yeah,
good
yeah,
luck
yeah,
with that. Make sure your name is spelled out. Your first name is really clear because
yeah.
it is. People understand the liability you take on. You take on a business that has these
Yep,
assets, and you're just liquidating the business. It's no different than if you went into, I don't know, McDonald's franchise or automobile parts store, and your job was to take over there and run the business while you
yep,
sold everything and liquidated it, and you have all the responsibilities and liabilities of running that business until it's gone. And even then, you have the contingent liabilities that go back in time.
yep.
And another good reason why you should get insurance. There's insurance for trustees and executives.
Yes.
As long as you're not cheating anybody, you can insure a lot of that risk. But again, talk to a proper insurance company about getting those things done because it's not
Yep.
easy work.
The other thing that a lot of people don't realize when you become a trustee, you become subject to the prudent investor rule. So you have to invest the funds to where you're getting a good, healthy return, but not where you're taking too much risk. So you kind of have to balance that. I'll tell you a true story. I had a client, they agreed to become trustees for a large estate. They did not invest the money allegedly as well as they should have. They went super conservative just in, trust deeds and CDs and things like that. And they got sued because during this time, it was a long estate. It took 4 or 5 years to close the estate. During this time, there was a big market run up. Okay. And the beneficiaries said, hey, you had this money in CDs earning 3 or 4%, when if you'd have put it in in good stocks, good blue chip stocks, we would have gained 30% of our money. It turned out to be millions and millions of dollars. It wiped them out. I mean, they had a pretty nice estate of their own, and they lost based on the prudent investor rule, and they're now living in a trailer park somewhere in Texas. It was not pretty.
Wow, wow. And I think of course, if the same party had invested money in some stock that turned around, maybe it looked like a good deal when they started, and it just turned around, lost 30%. They'd sue them for that too, right? The same people.
Exactly.
An eyelash.
From my point of view, it is a no-win situation. I would never be a trustee. There are professional fiduciaries that do this. There are independent fiduciaries, and then of course there are your larger fiduciaries, like most of your banks and Wells Fargo and things like that have professional trustee departments. So my feeling personally, and for my estate, I'm going to lay that off on a professional fiduciary at a large institution. And, then I know it's taken care of. The other thing is, if you lay it off to a fiduciary at a large institution, you have a deep pocket, because most fiduciaries are very, very good. I work with some private fiduciaries who I trust implicitly, but there have been known to be crooked fiduciaries. And if they pack up all the money and go to Guatemala, you're pretty much out of luck. Whereas you don't really have to worry about that so much at a Wells Fargo or wherever, Morgan Stanley, wherever the large fiduciary is.
When I started in real estate, I was in the mortgage business, and I had a client who was a huge realtor, and she was working with this fiduciary who managed people's wealth and was buying property and investment property, doing incredible business, and all kinds of loans. And I knew the guy really well. I mean, he seemed really nice, and she was fantastic, and they had a beautiful house, and everything seemed to be. And one day, the office was shut down. I found out he was embezzling funds and had been for like 10 years. And
Oh my
every
God.
deal we did was some sort of fraud where he took money, he took extra money, and he transferred deeds. And, it just, my point of all that is to say, you don't really know people. Like, and I thought I knew her pretty well. My wife actually, she hired my wife to be her assistant because my wife was helping me in my business when we were young. And she said, I'm looking for an assistant in my business. Hey, my wife could do it for you. And they paid her a
Yeah.
really nice salary and treated her really nicely. And she
Yeah.
was in the office. But this guy made off with, at that time, this goes back in the like early 1990s, tens of millions of dollars that he made off
Oh
with.
my gosh. Where did it end up for him?
I'm sorry?
Did he get away with it, or did he get
No, he
arrested?
went to
Or
prison. He went to prison.
okay.
And
Yeah.
and and a lot of customers were affected. And I had customers call me upset. And I knew nothing about it. I was just doing mortgage loans because they were buying property. So in a sense, and he would give me their tax returns, he'd give me their bank statements, he'd give me asset statements. It was my part of it wasn't really any of the fraud. The fraud was the proceeds were being wired into his account. But
Yeah.
again, I you think you know people, and I'm a pretty good judge now. Maybe I'm older. I'm much more careful. But
Yeah.
I would say, look, there's professionals, there's licenses, there's insurance, there's people who work with good vendors. I think that if you're going to work with a fiduciary, I work with one quite a bit in particular, but he has top-notch, love to introduce him to you, David. He has other,
Sure.
accountants he works with and wealth people and attorneys and all that. That's a good sign that they're working with these people, not that he's controlling them all, but that he works with them as vendors. But that business, that fiduciary thing is on one hand more and more necessary as these things are more complicated, and yet is treacherous, I think, to go through.
It is. It is.
It's important, like you say, people that implicitly. I think that it's because you work with them for a while, you have the depth, you see them. It's important at a professional level to make sure if you're going to make a recommendation, you really know who you're talking about, because you just don't know sometimes.
This is very true. Okay.
I'm sorry, go ahead.
Go ahead. No, I was going to say, moving on, I want to kind of reiterate again on the trust and estate level, because we now have this $15 million exemption is now permanent, or as permanent as anything can be coming out of Washington. The shift is going to be much more away from trying to avoid the estate tax, because most people have estates that are smaller than $30 million, toward seeing what we can do about income tax. And this, is a very major shift, because you have to remember, going back, oh gosh, I remember maybe in the 80s, that estate tax exemption was only $600,000, per person. And then $600,000, even in 1985, was not a huge estate. So people were always worried about the estate tax. But now we have $15 million per person. So that takes some pressure off of us on the estate tax. And I think you're going to start seeing a lot fewer grantor trusts. Let me just explain what a grantor trust is. A grantor trust is what's sometimes commonly referred to as a living trust. That's where for income tax purposes, there's really no difference between the person and the trust themselves. The income that the trust is making is taxed at the personal level. The trust can be changed at any time up until the person passes away. Now, of course, once the person passes away, that trust then becomes a permanent trust. But these grantor trusts have been used extensively the past 40 years to avoid the estate tax. And another good reason for them actually is probably the most common reason is they avoid probate. So when you pass away, everything just automatically transfers in trust to your descendants or your surviving spouse, however you have it set up. But I think what you're going to see among higher income people is the use of trust toward non-grantor trusts now, irrevocable trust. Well, why is that? That's because we can use these trusts and use some good things that have come to us in the recent tax law changes. We can use those to really possibly save some income tax. Okay, so part of that is going to be basis. We're always looking to get a step up in basis. So I just want to give you one little tip here. If you're using a non-grantor trust or an irrevocable trust as part of your estate plan, there is something called a general power of appointment. Okay. And if you combine a general power of appointment with a non-grantor trust, you can get a partial step up in basis for your unused $15 million portability item. Okay, so that means when I'm referring to step up in basis, you probably just really quickly talk about that. Normally when somebody passes away, let's just say you have property and community property, which from a tax point of view is generally the best way to own property. And I may have used this example with you before, but I'll use it again. Take my parents, for example. We're both pushing age 100. They purchased their house in 1969, and they paid about $40,000 for it. Okay.
And it seemed like a lot to them at that time. It seemed like a lot of money.
It really was in 1969.
Crazy. $49,000 for a house in Pasadena? Are you crazy?
Yeah, and it is a beautiful house in a very nice neighborhood, has a pool, fruit trees, the whole thing. Well, that house now is probably worth somewhere well over $1 million. Okay, $1 million to whatever. So let's just say round numbers. Let's just say it's worth right now $1,040,000. Okay, now when eventually one of them passes, the basis of that house for income tax purposes will not be $40,000 anymore. It will be $1,040,000. Okay, if the house is held in community property. Okay, which is one good reason to have your house in community property as opposed to joint tenancy. So everybody might want to check their deeds. So let's just say my dad passes first because he's the oldest. My mom, if she wanted to, could then turn around and sell the house for $1,040,000. And on that $1 million worth of appreciation that they've had over all these years is not subject to income tax on the state or federal level. She skips off without paying a dime on any of it. The same holds true for all other property that is in community property, artwork, jewelry, stocks, anything that's subject to a step up in basis. So a lot of what we're looking at now, which is obviously that's a huge benefit. Okay, so a lot of what we're doing now is we're looking at how we can get a step up in basis when somebody passes away. Maybe the house isn't held in community property. You can leave the property in trust with a general power of appointment to the trustee, and that will give you a step up in basis on the property that was in the trust. So if you insist on leaving that property in an irrevocable trust, which people do still, I mean, there are reasons for it, liability protection reasons, and so on. But I think the takeaway here is talk to your lawyer or CPA if you've got this property in an irrevocable trust or planning on putting it in an irrevocable trust. Ask him, well, who can we give a general power of appointment to so we can get some further step up in basis? Because if you don't do that, what happens is, let's just say my dad puts his share of the property, his half of the property in trust. That's $20,000. Well, his half of the property, when he passes away, if it's in an irrevocable trust for benefit of somebody else, the basis remains at $20,000. Okay, so you want to be very careful when you're putting this property in an irrevocable trust, because unless you combine it with the general power of appointment, your basis is going to be stuck at whatever it was, whatever your basis was. In the case of my dad's house, his basis is $20,000 because he paid $40,000 for it 50 years ago, more than 50 years ago. So that's just something to be mindful of.
And these irrevocable trusts are common for asset protection, and
yes,
for Medicare planning or for other planning purposes. And so while they're great for all that, you're adding another piece that we'll consider also maximizing the benefit of it at some point in time when they pass to get the step up. They won't lose the step up just because they use the irrevocable trust versus revocable.
That's correct. So at least they won't lose all of it. There is a formula that goes into how much of your remaining $15 million exemption you have. So it's a bit involved. I just want to highlight. The issue. The other thing that we're using trust for now, again, irrevocable trust, is most people are probably aware that since 2017, our state and local income tax has been limited to $10,000 on a personal return, right? And that was very painful for people who live in California, because many of us are paying easily 30, 40, 50,000 or more in state and local income taxes just on our property tax, not even including our income tax that we pay. Okay. So if you have a guy or a person that's living in, Bel Air, and they're paying $90,000 a year or more on their property tax, and let's just say he's a lawyer earning $1 million a year, he's probably paying at least $100,000 in personal income tax. So now you have a person paying, $190,000 in property tax plus his personal income tax. How much of it was deductible before this bill? $10,000. Okay, it was a huge hit, very, very, very painful. Okay, so what the new tax act did is it said, all right, we will let you deduct up to $40,000 a year in state and local income taxes. So that's a big step up from $10,000. So what does that mean to us? Well, it's not going to help everybody, that can't use a trust, but let's just say you have a rental property, and you have quite a bit of it. Well, maybe it makes sense for me to break up these rental properties into separate trusts, okay, for my kids. Say I have 5 children. So say I take 5 properties, I put 1 property in each trust, irrevocable trust for benefit of my children. And now what have I done? I've taken my $10,000 deduction for state and local income tax, and I multiplied it by 4, because each trust could have up to $40,000. Okay. So now by breaking into trust, and there are some income tax limitations, but the 40,000 phases out at about 500,000 of net income. But there are ways to work with that as well. So now I have taken advantage of that $40,000 SALT by using these irrevocable trusts. Now, there's some things you have to be careful of, because what you want to do is, remember I said before, your trust income, the top tax rate, it hits 37% after $15,000, right? And for a married filing joint return, you only hit the top tax rate after $600,000. So what do I want to do? What I want to do is I want to take as many expenses against the trust income, excuse me, including that $40,000 SALT, including everything else that I can. And then if I'm still left over with profit, I want to distribute that profit out to the beneficiaries, the children. Why do I want to do that? Because it's going to be taxed at a much lower rate than it will if you tax the trust. Now, obviously, this technique is not going to work for everybody. Okay, but if you have people that are older, maybe they're in their 60s or 70s, they're starting to do some estate planning. They want to start to get some of this property to their kids. Maybe they use part of their $15 million exemption to get the property out to the kids, and they start to take advantage of some of this stuff to reduce their income, where you wanted to transfer this property to your children anyway. This is a substantial way to save quite a bit of income taxes, because if I increase that SALT deduction from $40,000 to $200,000 by sprinkling it across irrevocable trusts, well, in 5 years, that's $1 million tax deduction, and that saves you, combined state and federal, over that 5 years, that saved you about $500,000. So that's some significant money.
Well, for sure. Well, again, I think the key takeaway here for everybody watching this is it's not that he gave you a blueprint for your finances. It's he gave you some key highlights to think about. Get together with David or an expert in these areas and see if you can take advantage of these. Because I know this, because I do real estate. I don't do the tax side. I sit on these meetings with attorneys and accountants and look after the fact. there are huge amounts of money that get thrown away because the planning wasn't done ahead of time. Now, it's expensive. There's things you can repair after the fact, but it is much cheaper to plan ahead and take advantage of these opportunities than it is to reply after the fact, and that's why you want to get on that. So, David, look, I know it got a little longer than I planned on. I really appreciate, and I also was a little late, so I appreciate your time today.
No problem.
For anybody who wants to get a hold with David, David is at Ellis and Ellis CPAs.com is the website, and his contact info is below, 626-577-4404. Of course, if you don't know how to get a hold of him after the fact, feel free, if you didn't take notes here, just reach out to me. I've been, like I said, I went to college with David. We've known each other for, I graduated in 1980, so it's been a lot.
It's been a while.
It's been a few years. David, thank you so much for your wealth of knowledge that you shared with us today. I really appreciate taking time and sharing with it. And,
Sure.
And sharing some of your own story. I really appreciate it.
Okay, thanks, Bill.
And for the rest of you, this is Estate Planning Weekly. We get together every week with estate planning attorneys, accountants, CPAs, vendors to learn how to better serve our customers. And sometimes more importantly, just to learn how to motivate our customers to take that action. Again, preparation is so much more important and so much more effective than resolving things after the fact. If I can help in any way, please reach out at Bill Gross Probate on social media. As always, make today your best day ever. Thanks so much.